Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Monday the 18th of December at the start of the final week before Christmas. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Nicholas Agazan is set to leave his role as chief executive of Hong Kong's stock exchange operator HKEX. Mr. Agazan, a former JP Morgan banker, informed the board that he will not seek reappointment at the end of his current contract in May 2024. The exchange has named its first woman chief executive. Bonnie Chan, one of the firm's two co-chief operating officers, will take over in May 2024, succeeding Mr. Agazan as chief executive with a 3-year term. China's economy posted mixed results in November as policymakers continue to grapple with an array of challenges, including a real estate slowdown and deflation. Industrial production came in ahead of analyst expectations at 6.6%, expanding at the fastest pace since February last year. Retail sales were lower than economists' forecasts, rising 10.1% year-on-year. Hong Kong Financial Secretary Paul Chan on Sunday said the government needs to control its spending amid pressure on the public purse. Writing on his blog, Mr. Chan said government expenditure has grown much faster than its revenue in recent years, even if anti-pandemic measures were excluded. Mr. Chan said he expected a budget shortfall of just over 100 billion Hong Kong dollars in the financial year ending March, which will be double the amount anticipated at the start of the year. He said it's possible the government will stay in the red for 2024 to 25 as well. President Xi Jinping said Chinese modernisation will benefit US firms in a letter sent to mark the 50th anniversary of a Committee on China-US Trade. The letter was read out at a gala dinner in Washington, during which US Treasury Secretary Janet Yellen accused Beijing of unfair economic practices. President Xi wrote in his letter that Chinese modernisation will bring more opportunities to global enterprises, including American ones. There is great potential, broad space and promising prospects for strengthening China-US trade cooperation, he said. On today's programme, I'm joined by Alex Wong, Director at Alex KY Wong Asset Management, and Frederick Chu, Managing Director at Magnum Research. Providing a view from mainland China will be Brock Silvers, CIO at Kaiyuan Capital. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Friday, shares on Wall Street closed out their 7th straight week of gains. The Dow closed up 56 points, or 0.2%, at a new all-time high of 37,305. The S&P 500 was virtually unchanged at 4,719. The Nasdaq Composite closed up 52 points, or 0.4%, at 14,814. The Nasdaq 100 ended Friday at a new record high. The S&P 500 was up 2.4% on the week and is within 2% of the record high it hit in January 2022. And the index is up 7 weeks in a row, its longest winning streak in 6 years. The Dow climbed 2.9% over the week, while the Nasdaq Composite added 2.8% over the same period. The yield on the 10-year US Treasury note fell to 3.92%, down 31 basis points on the week to a 5-month low. The 30-year yield tumbled 30 basis points to 4.01%. That's the lowest level since July the 31st. The US dollar index jumped 0.6% to 102.5 on Friday after Fed President John Williams told CNBC the central bank isn't really talking about rate cuts right now and it's premature to be thinking about a March interest rate cut. However, the index saw a steep weekly decline, falling 1.3%. The yen traded 0.2% lower at 142.15, but near a 4-month high to the dollar, having appreciated sharply against the greenback in recent sessions. The yuan traded 0.1% lower at 7.1179 after the People's Bank of China injected 1.45 trillion yuan into the economy through its medium-term lending facility. Gold prices fell on Friday as the US dollar rebounded, ending the session 0.9% lower at $2,018 an ounce. For the week, it was up 0.7%. Brent crude oil futures settled down 0.1% at $76.55 a barrel, and for the week, Brent rose 0.9%. That's its first weekly rise in 2 months. Bitcoin and Ethereum were both down around 4.5% on the week. Bitcoin ended the week at $42,170. Hong Kong stocks surged in their best week in more than 4 months after China took measures to spur home sales in top-tier cities. Optimism about an imminent end to global rate hikes also fanned the gains. The Hang Seng surged 390 points, or 2.4%, to end at 16,792 on Friday, rallying for the second straight session and jumping by 2.8% for the week. And the index also notched its highest level in 2 weeks. The tech index surged 2.2% Friday and was up 2% for the week. And on the mainland, the Shanghai Composite fell 0.6% to 2,943. And for the week, it was down 0.9%. Does look like, though, the Hang Seng is going to see some sharp losses at the open. Futures markets pointing to a decline of about 240 points. That's 1.4%, with the index starting the day trading at 16,550. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Monday morning guests. We have with us this morning Alex Wong, Director of Alex KY Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also with us, Frederick Chu, Managing Director at Magnum Research. Good morning to you, Frederick.
Good morning, Peter.
Now, Nicholas Agazan is to leave his role as Chief Executive of Hong Kong's stock exchange operator. Mr. Agazan, who's a former JP Morgan banker, informed the board that he won't seek reappointment at the end of his current contract, which ends on the 23rd of May next year. The exchange has named its first woman Chief Executive. Bonnie Chan, one of the firm's 2 co-chief operating officers, will take over in May 2024, succeeding Mr. Agazan as Chief Executive with a 3-year term. And Hong Kong Exchange's share price has plunged 42% since Mr. Agazan's term began in the depths of the coronavirus pandemic and has presided over 6 consecutive quarterly profit declines. The bourse's third quarter results showed revenues from trading activity fell 10% from a year ago, while stock listing fees slipped by a fifth. And IPO deals in Hong Kong are on track for the slowest year in more than 2 decades. Cash equity trading this year was down 16% compared to last year, and the market's benchmark Hang Seng Index has dropped over 15% this year. And meanwhile, India's National Stock Exchange has overtaken Hong Kong's to be among the world's largest trading venues. Alex, it's been a challenging year, hasn't it? I'm not sure how much those dire figures could be down to Mr. Agazan, because I presume anyone who was the CEO of the Hong Kong Stock Exchange over the last 3 years would have faced quite some considerable hurdles.
Yeah, of course. I think this is not about the personnel problem. This is about the macro problem we are facing. The continuous decline in the Hong Kong market and also the lack of interest of IPO. I think is very bad for the Hong Kong EX. So I don't think it is his fault. I think this is just the environment.
And is it going to get better?
I don't think we would get much better. Probably we may still see turnover to remain low, even though probably price-wise we may have some support and we may see some rebound in price, but I don't think the turnover would improve much. And IPO actually would not be too much better as well, because if you look at Shein decisions, even if they face some hurdle to list in the US, actually they are talking to the LSE. I think that is a quite bad signal for Hong Kong.
Yeah. Yeah. Frederick, what are your thoughts on this? As Alex says, it's probably not really a personnel problem, is it? There's some real structural issues and macroeconomic issues.
Yeah, I think so too. I mean, traditionally the exchange is very, very much subject to the capital market situation. If you look at when Gucho comes in 3 years ago, it's basically the worst time of the year, in history for the exchange, where you compare with his predecessors, which is really not something that one person can change. But I do looking on the bright side. I mean, we can see the exchange is putting in much effort to develop some of the auxiliary businesses. For instance, the fund distribution platform, things on the ETFs, to try to do a little bit more when the IPO is not as good as expected. But then instead of just sitting there and wait for the time to come back, they try to do something, in catching up with the trend, which I think, the exchange do have quite a bit of things, on automation, digitalization, etc., or acting as a regulator or quasi-regulator in helping the financial markets in Hong Kong to diversify. I think that's something that, I would expect from a COO background, incoming CEO.
I mean, to be fair to Mr. Agazan, under his watch, he has expanded trading links, hasn't he, between Hong Kong and the mainland. We have interest rate swaps now, exchange-traded funds included. He's also brought in the yuan counter-trading to try and boost the use of the Chinese currency. These are presumably all good things and the right thing to do.
Yeah, absolutely. I mean, the expanding of trading links in between Hong Kong and China, it is definitely one value to add, but given the general perception into China Asia's market at the moment, it's not really reflecting at the moment. But for the longer term, I think the exchange can build up quite a bit more.
Alex, I'm wondering though about the Hong Kong exchange's strategy. Is it on track? Because its strategy seems to be now to try and get Middle Eastern companies and other Asian companies to list in Hong Kong. Do you think that's going to work?
I think at least this is the right direction. It is quite difficult to predict whether it will work or not, because first of all, for Southeast Asian companies, actually, they always can pick the US as well. We have Grab, we have C listed in the US, and they are quite popular. We still need to compete with the US for those areas. I think Middle East probably would be easier for Hong Kong, but interest for Middle East companies may not be too much in the meantime. Because even though they are performing quite well, but the sector-wise, I think is quite concentrated, and people actually need to get acquainted with those companies. So I think the strategy is right in the direction, but it needs time to execute.
I mean, we do have this Saudi Arabian ETF, which was listed last month, wasn't it? But the problem is there's just not many of them, is there? Even if we make it a core part of the strategy, there's not a lot of Middle Eastern companies and ETFs that could list in Hong Kong. Yeah,
we have already the largest one listed already in Hong Kong. And I think that probably interest may be picking up later on as we see the performance to improve. And then also in Hong Kong, probably people would like to diversify their allocation, but it is not easy to get acquainted with the individual companies behind the ETF. So I think it will take a lot of time to see the results.
The problem is people regard the Hong Kong exchange as basically a window for Chinese companies, but you have the sort of safe haven here of English common law and sort of international regulations. It seems that moving away from that is going to be quite tough, isn't it? Unless we sort of stick with that, it's going to be very difficult to explain what is the purpose of Hong Kong.
Yeah, but I think if you just stick with a Chinese company, then probably this is already we have already seen the best time over, and so we need to move towards other area to try to make use of the current infrastructure to diversify the listed company structure. So I think this is a good move, but of course it is difficult.
Frederick, do you think strategy is on track? What do you think of this effort to try and get Middle Eastern companies to come and list in Hong Kong?
Honestly, I don't really think the Middle Eastern company will be, picking Hong Kong as a priority for listing. I mean, apart from going to the US, which is, maybe it has a higher bar, then the second choice would definitely be Europe, which Middle East has been all closely connect with legally and commercially. I mean, in recognition of the financial legal framework, they're very much more familiar with the European version. Putting up a Middle Eastern company in Hong Kong, whether via a wrapper or a direct listing. First of all, I think it's the attraction from the general investors, which I agree with Alex is going to take a much longer time. For the exchange, I think it's probably time for the exchange to rethink as being a middleman for the Chinese company to come here. I think there'll still be a market of that because of the geopolitical reasons that company used to choose to go to US may remain in Hong Kong, even though the market cap is much smaller, but still a way out. But on the flip side, I think the exchange should probably come into more play around as a quasi regulator, as I repeated, how to beef up how to build out the entire financial market, how to contribute to the sustainable development of the financial market in Hong Kong.
Has Hong Kong just got to ride it out? I mean, its role, which has been a good one, has been bringing Chinese companies to the world, to the attention of international investors by listing here in Hong Kong. Obviously, those deals have dropped quite considerably over the last year or so. I mean, proceeds from IPOs have fallen 59% year on year. But the strategy isn't necessarily wrong, is it? Has Hong Kong just got to ride it out, or are we not going to ever get back to those levels of IPOs and now we need to do something different?
Yeah, it's not wrong. I mean, it's correspond with the proposition of Hong Kong itself, but it's just a timing issue. Before, when Chinese company come to Hong Kong to list and internationalize themselves, it's at the time when the foreign investors would love to buy those companies, right? But right now, the foreign investors would want to divest from China companies, which is a fundamental problem for the drop of the listings.
What do you think, Alex? Do you think we just got to try and ride it out, or do you think maybe we're not going to get back to the sort of levels of listings that we saw in the past, and therefore we need to carve a new role for ourselves?
Yeah, I think we need to look for new source of IPO because in China, I think we have several attractive ones still not listed. But as I've said, Xin is talking to the LSE right now, and that is a very big damage to image actually, because the better ones actually, or the bigger ones actually, are picking up other paces, and Hong Kong is not the preferred destination anymore. Then that means that you have to do something else. Otherwise, I think relying on China actually, you will get the smaller one only. So I think this is a move which is necessary.
Okay, well, let's turn our attention to the Chinese economy. Plenty of data out on Friday. It was sort of really a mixture of the good, the bad and the ugly. The good was industrial production, which expanded at the fast pace since February last year. The bad was retail sales came in lower than economists' forecasts, and the rate of increase is slowing. And the ugly was basically anything to do with the property sector. Frederick, what was this data telling you about the state of the Chinese economy?
Yeah, it basically tells the weakness of the in the economy has not been changing. So if it's not getting worse, I mean the two biggest engine right now that the people are looking at it's domestic consumption as well as properties. Right now, property is really going nowhere. No one is thinking about buying a house because of down payment, because of the affordability, etc. But the thing is, it's not picking up, even though you have put up lowering down payment, some sort of the policy suites, but it's just not working. It's not strong enough. Consumption-wise, I think it's the same thing. For Chinese people, culturally, if your properties are not, if your property investments or your stock investments, etc., are not giving you, any positive return, then that kills your, consumption, appetite. So I think it's gonna be, going through this tough time until something comes up. For instance, when the U.S. Start to cut rates, or which let the Chinese government can cut further up in terms of loosening monetary policy, and that could be a turning point. But right now, it's just there.
Alex, what are your thoughts on the data? Do you think, as Frederick says, when the US starts to cut rates next year, if it eventually does, that's going to be the turning point for the Chinese economy?
I think that would help the manufacturing sectors. I think the data show the resilience of Chinese manufacturing sector. So we are probably absorbing the downside of the +1 strategy already, because Chinese manufacturer actually has a very strong advantage in their infrastructure. So that is not easy to replace. So I think for that part, that is okay. But for the consumption part, this is really a confidence issue. And then for the housing market, I think other than those first-tier cities, actually, this is very difficult to see a revival in interest in those third-tier or fourth-tier cities. So it's likely to drag the spending in those areas for quite some time. So even if U.S. cut rates, I think we probably may not see too much revival in the housing market, but probably we may see some improvement in Beijing and Shanghai. But other parts of China is very difficult to rebound. And for the whole Chinese consumption, I think this is a confidence issue. So it will take some time.
So the Beijing and Shanghai, they rolled out some fresh easing measures last week. Is that going to help? And is that something that could be replicated in other cities that would make a difference? Because if you look at those housing numbers, they're not great, are they? New home prices dropped for the 5th consecutive month, and second-hand home prices down 0.8% now in November from October.
Yeah, I think that they help to contain the decline in Beijing and Shanghai. But for other cities, I think it's very difficult to replicate, because it needs inflow of new people to support the prices. I think for cities outside the biggest one, I think it is very difficult to attract inflow. So that's why I don't think this kind of move can be successfully replicated in other parts of China.
Frederick, what did you make of this big liquidity injection that we saw from the PBOC last week? In fact, the biggest on record. The PBOC injected a total of 1.45 trillion yuan. That's about $112 billion into the banking system. Taking into account the MLF loans that are going to expire this month, the net liquidity injection is about 113 billion. So it's the biggest medium-term liquidity injection ever. What is there something going on behind this that's keeping the authorities worried here?
Well, I think that the question is always wondering on this. It's how much of this injection can really pump into the real economy and in what pace. I think it's no doubt that the Chinese monetary policy it's on the loosening side. But how much loosen can it go at this point of time? I think considering the rate gap in between China and US, it's not going to be massive. The RMB FX is not really too much of a concern, but it's really of the capital outflow, which concerns the Chinese government. So I think for the near term, that's why I sort of benchmarking on when US is going to lower the rate. Otherwise, I don't see some particular the strong stimulus is going to come in.
And did you hear anything from the Economic Work Conference last week that makes you think that maybe some of these policies are going to make a difference? I mean, they were talking about any policies that interfere with growth are going to be reevaluated and potentially changed. Was there anything there from that Economic Work Conference that was a game changer?
No, I personally haven't heard something, too outstanding. Apart from obviously there will be a couple more regulations come out on the on the non-bank payments, etc., which is more of a industry, industry regulating the industry a bit further, which is also necessary, I think.
Alex, did you hear anything from the Central Economic Work Conference? Did you get the impression that at least there's more of a sense of urgency in Beijing to try and deal with the growth issues and maybe to make growth a priority once again?
Actually, no. I think they have already put so many policies out, and I think there's not much surprises to the upside last week. So we still need to see whether they let the private enterprises do the job. And actually, I don't think they can do much from the government side other than losing on the monetary side.
And anything to deal with deflation? That's presumably becoming a big issue as well, isn't it?
Yeah, that is a big issue because it would defer consumptions. But I have said that there are so many deflationary forces in China right now, so it probably will still be a problem. And there's not much you can do because the advance in tech is quite deflationary, especially in China. So it's quite difficult to reverse the trend. So they need to do something, but I think it is very difficult to exercise. They can pump a lot of liquidity, but the point is the RMB cannot be too weak. So I think, and also the capital outflow issue. So I think that is quite difficult to reverse the inflationary picture.
Okay, let's turn our attention to the markets. Frederick, global markets, particularly stocks and bonds, got a Christmas present from Jerome Powell last week, who sort of rather suddenly out of the blue, from saying that interest rate cuts were off the table, is now indicating maybe 3 interest rate cuts next year. Nevertheless, this is sort of lit a fire under global stocks and bonds, isn't it?
Yeah, it was quite encouraging, to be honest. I think at least one thing we can be sure is the rates, it's not going to get much more higher next year. But whether it will just come down like that, I am not 100% confident as yet, because I think, only one indicator here is the inflation, which, from the projection of the Fed, the PC is going to be 2.8 and 2.4, as I remember, for next year. 2.8 for this year and 2.4 for next year, which is very, very close to the original target. But as yet, it still has a process of coming down, which it may take another 6 months or 9 months or even 12 months to really come down to to that level. So I think, given all the economic indicators, the job markets are still resilient in US, even though it's slowing down, but it's still strong. I not 100% confident say yes, we are very comfortable in looking at a rate cut starting in Q1, Q2 or whatever.
Alex, are you?
But I think the market.
Sorry, Frederick, carry on.
Yeah, I think that the market is just reacting as naturally when both the S&P and the Nasdaq are going through going towards the all-time high.
Alex, are you surprised? This is a very sudden pivot, isn't it, from the November meeting to the meeting last week? I mean, at the November meeting, there was no talk at all of rate cuts, and Jerome Powell was going out of his way to stamp on any speculation that there could be. And now suddenly we've got 3 rate cuts. What sort of changed in that time?
Well, I think it's only the inflationary picture. The growth picture remains more or less the same. The job market is still very resilient, and the economy actually is doing quite good in the US. So this is the inflation expectation. I think they're changing. So and I think probably it is too early to call for an early rate cut. As I concur with Frederick, I think the overall growth picture remains quite good in the US. So probably the market is too optimistic about the rate cut scenario right now. But the inflation picture, I think, has changed, and very likely we may still see continued downward pressure on inflation.
Well, when you say it's changed, in what way? Because the Fed is still quite a long way from its 2% target, isn't it?
I think at least there's not much speculation in the commodities market. oil actually is quite weak given the Middle East tension. So people are not speculating on oil. I think that is helping. And other commodities actually are quite weak. I think apart from the US, other parts of the world actually may not have that kind of a resilience in the economy. So I think that is helping to contain the global inflation, and that is helping the US inflationary picture as well. And probably the job market will still be quite resilient in the US. But I think overall, the global picture probably may help the US to contain the inflation.
So is higher for longer? Is that now dead?
I think we may still see higher rates for at least several months. I think it's still too early to call for a rate cut in March, I think. So, but the timing of the cut is not too important. I think the market actually pays more emphasis on the direction. So the rate cut may come eventually. So it is not too pivotal whether it's in June or in March, I think, in the market views.
Frederick, I'm wondering about the markets. Fed Fund futures markets are now pointing to 6 rate cuts next year, 1.5% of rate cuts. The markets just seem to be moving away all the time from the Fed's forecast. But I'm wondering what on earth could cause the Fed to cut rates 6 times next year. I can't imagine that it could be anything good.
No, I don't think towards that as well. I think the market somehow has been over digesting on the optimistic side. I mean, if you look at the inflation, as I said, it's still in the progress of reaching down to the 2%, which is still a way to go. So if we assume in the next 6 to 9 months, the inflation is not dramatically dropped, then which means the Fed rate is going to be remaining at a high level before it really comes down. It's not going up, yes, but it's not coming down either. So it's still maintaining a 5.6 high level, which means the cost of funding is still high. Risk-free rate is still standing up there, which kills the investment appetite as like this year. Nothing has been fundamentally changing, which then, as far as we can see, if that stands, then the capital markets will more or less be remaining at the same, right? So, I don't see really a very strong bright side of things that could happen unless we have a very solid projection that the rates is going to come down because inflation is really going back to the target level.
Okay. Alex, Hong Kong stocks, at last we've had a good week, the best week, in fact, in about 4 months. Obviously, this imminent end to global rate hikes has helped. Is this now a game changer? Do you see now maybe we've reached a turning point for Hong Kong stocks?
This is one-day strength only. We have seen too many unsustainable rebound in Hong Kong in the past several months. So it's still too early to call for a reversal. But I think at least probably we may see a bottom finally around 16,000. At least I think it will hold for this year, because the sentiment during the low actually is too bad. I think at that time. So people was too pessimistic. I think we are likely to see support, and I don't think that people would aggressively short the Hong Kong market because of the rate cut expectation in the world. So short selling probably may subside, and then we may see some catch-up buying in Hong Kong for a while. So we are likely to see some more rebound, I think. But I doubt that the upside may be too much because you can always go elsewhere to look for continuous gain. But in Hong Kong, given the China uncertainties, people probably may still be very unwilling to commit money for long term. So I think we may see some more upside, but I don't think we may see a very strong gain and a reversal.
Are investors sort of taking the view that if they want exposure to China, they can do it without actually the risk of buying Hong Kong and Chinese companies themselves, because there's Japanese companies, Korean companies, Taiwanese companies with good exposure to China? Is that part of the issue?
Yeah, that is an issue, because you can see the share price performance in companies like Nike, Adidas, and Hermes, actually they are doing very well despite the weakness in China. So I think they are always a safer place to play the China consumption story. But the point is we have the Chinese brand names are to be too depressed right now because of the corporate governance issue and then sovereign issue. So they are quite cheap actually. And I think another point is the global appetite towards the necessary items actually are too bad because people think companies like Costco or PDD actually are taking over. So people have a preference towards those kinds of network instead of brands. So brands for lower price items actually are depressed in the world. But I think that trend actually is too overstretched. So we may see some reversal in some brand names in the world. And Chinese also have got some weakness in those sectors. So I think prices, brands like beers and probably necessity items actually would be okay at this level.
Frederick, just a few seconds, final thoughts from you on Hong Kong, China markets.
Agree with Alex. I see probably another 5 to 7%, gain back on the 5 strict months of losses, but not something that's a fundamental reversal of the trend. So yeah, I think that's also my view.
Okay, well, thank you both very much indeed. Have a great week ahead. That's Frederick Chu, Managing Director at Magnum Research. Alex Wong, who is Director of Alex KY Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital. Good morning, Brock.
Peter, good morning. Good to be here.
Thank you. Thank you for joining us. Well, we had a big day of data on Friday, activity data for China, retail sales, fixed asset investments, industrial production. It was a bit of a mixture of the good, the bad and the ugly, wasn't it, really? Industrial production looked quite good. Retail sales missed. And anything to do with property looked really ugly.
Yeah, look, I think overall the data wasn't too good. You know, the booster crowd will tout the increases, but the earlier period comparison is really quite meaningless. We've got to look at the trends and the expectations, and that's where we saw some disappointment. You know, investment and consumer spending both came in positive, but lower than forecast. For example, you know, retail sales came in at 10%, but we were expecting 13%. So that certainly isn't good. New home prices, especially in big cities, are dropping at an increasing rate, also not good. And recent data have shown declining imports, manufacturing activity, services activity, worsening deflation. What I think this means is it puts a nail in the coffin for the hopes that the third quarter data was showing that a recovery had arrived. I think that is now, seen as never having been realistic. I would say this sort of uneven, middling performance, that's exactly what I would expect until we see greater kind of systemic reform, which I don't think is likely right now.
Do you get the sense that there's any urgency from Beijing in dealing with this, particularly after the Economic Work Conference? Do you get the impression at all that at least growth now is at the top of the agenda? Because people have been thinking that there are other things that have really been more important than growth, like stability, national security. Is growth the number one priority for the Chinese government?
Look, I think the government is certainly worried about growth and certainly focused on it. You know, China has already responded with an injection of 800 billion yuan, 110 or 112 billion USD, which is massive by Chinese standards. But here's the thing, that won't matter. The problem we're facing now is not a liquidity squeeze. You know, re-lubricating an already lubricated engine does not improve performance. So I think they are worried about it, but I don't think they've been backed into the corner where they're yet taking the appropriate actions. And as a result, I just don't see 5% as real this year. And I think it's probably less real next year.
So what would be the appropriate actions? What would you like to see Beijing do?
Well, look, I think that we've hit some systemic limits and we need some reform, but that becomes a political issue. And if China's not ready to take that route, that's fine. That's over my pay grade. But without systemic reform, I just think we're in for the sort of, middling, a bit up, a bit down kind of performance that we've been seeing. And things do seem, the cyclical issue will not be here forever. The cycle will turn. But that doesn't mean we're going back to the growth of yesterday, yesteryear. We're simply not. And let's also keep in mind that a declining U.S.-Sino economic relationship only adds to the expected volatility.
So we're going to meet the 5% growth target this year, aren't we? But are you saying that's really...
Are we? Are we?
Do you not think so?
Well, look, officially we may. I remain extremely skeptical of that, and as to how, what sort of growth that represents, and how real that data may be. So we may hear a 5% claim, but how much of that is kind of PR? I don't know.
So it's clearly off the table then for next year, presumably. It's going to be because it has all the data has benefited from this base effect, hasn't it? Comparing it with a period when China was in lockdown, the data's not going to get the benefit of that next year.
That's right. And look, the World Bank has just decreased their expected GDP growth for China for next year, and they're generally more bullish than yours truly.
What do you make of these attempts by Beijing and Shanghai to try and boost the property market, lowering down payment ratios on home purchases, extending repayment deadlines for mortgages? Is that something that's going to work and something that maybe should be followed in other cities?
No, look, I think that shows a government that is desperately looking for a solution, but hasn't yet amassed the fortitude to do what's necessary. In my mind, there's no package of sort of tweaks and mortgage rate adjustments that's going to solve this problem. In fact, I think the real estate problem is going to get worse. A single country garden payment to creditors last week is awesome, but it doesn't solve the 2024 problem. And developers are looking at a massive wave of maturities and obligations, which they cannot even hope to meet. So that problem is going to grow. It's on the downswing, not the upswing. At the same time, look, local government finances are a mess, and land sales aren't going to return to save the day. And LGFVs are facing kind of widespread insolvency issues as well. All of this has the potential to rock the banking sector. I mean, we should be thinking about China Inc.'s larger solvency. And Beijing, it doesn't have the firepower or the desire to backstop everyone. And that's why we haven't seen a sort of shock and awe stimulus package so far. Beijing is probably wise to conserve firepower until more is known, which will then force their hand, and they'll have the capacity to step in and do something larger scale. But that's where all the volatility is going to come from next year, I think.
I mean, China's not going to default on its debt, presumably, is it? Because it's a net creditor to the world, so net creditors don't normally sort of default. But Beijing has got the balance sheet, hasn't it? It could backstop some local governments, some property developers, if it chose to do so. But do you think that would be the right thing for it to do? Would that help?
Well, look, as a distressed investment professional, I can say that's a very painful process, and it involves the government really setting out a vision where it's going to have to start picking winners and picking losers, and it won't be easy and it won't be cheap. So that's a major commitment, and that's why everyone is reluctant to take that step until it's the only step left available, and they're not quite there yet.
And what about the fact that China's in deflation? That's another problem, presumably, as well, that Beijing needs to deal with as a matter of urgency.
Yeah, and look, that sort of ties in with some of the other issues, including, there are employment problems as well. some of that is cyclical, but some of it is simply not. There remains a significant amount of excess production capacity in China, which will continue to exert, I think, a mild but persistent deflationary pressure. And that's just going to be China's near-term reality. So I don't think that deflation, for a while we tried to deny it, and I think soon we'll declare it to be in the past. I don't think either of those is true.
Is the fact that the Fed is now talking about suddenly, out of the blue, 3 interest rate cuts next year, could that provide any respite for the Chinese economy?
It would. That would help the Chinese economy. Whether that was planned or appropriately understood remains to be seen. Because frankly, I was baffled by the idea that we're getting set for a string of rate cuts. The most that I can say is, look, it is an election year in the U.S., and I think there will be a lot of institutional pressure to reduce rates in order to influence the outcome of that election. And if that happens, it will release some of the pressure on China's economy, but certainly not enough to solve the problem. It will help at the margins.
It does seem odd, doesn't it, that in November the Fed was stamping down on any speculation of rate cuts, and then suddenly 1 month later it's talking about 3 rate cuts out of the blue.
And it's not as if anyone really thinks that inflation has been conquered. Or that the economy in the U.S. is doing so poorly right now that there just must be some support. Neither of those is the case. So it really was a bit baffling, and we'll have to see if that really turns out to be the case.
Could this prove to be a driver for Hong Kong and Chinese stocks, which, let's face it, have had a dire year, haven't they? The Hang Seng Index is down over 15% this year. The CSI 300 down almost 14% year to date, although we did get the best rally last week in 4 months here in Hong Kong. Could this be a turning point for Hong Kong and Chinese stocks?
Well, look, China markets performed terribly this year, but this was expected. Money Talk listeners heard me predict exactly that outcome roughly a year ago now. But looking forward to 2024, I think that the year will have more volatility and lower lows than we saw in 2023. So I'm not optimistic, and the big driver still remains China's economy, which I expect to muddle along for a while until the government sort of gets forced into taking some stronger action. That's not imminent, I don't think, and that means that I don't expect a great deal from Hong Kong or China markets in the coming year.
Yeah, I mean, you've been warning me and the listeners all year about the Hong Kong markets and the China markets and basically saying to keep away. And at some point, I think you even said they were uninvestable. But do you think going forward into 2024, is at least there any signs of a value play here somewhere?
No, I wouldn't do it. Not only are the investability concerns still with us, but I also don't think that China is ready to take the actions to turn the economy around. So we have those factors. I think that we'll see significantly greater volatility in the coming year. And look, the worsening relationship with the U.S. could represent even stronger volatility. And that, as I've said before, that could even grow to threaten the Hong Kong dollar peg, which is something that we should talk about on a future segment in the coming year, I think.
Well, definitely would love to do that. And thank you very much, Brock, for all your contributions and expert advice and wisdom this year. Very much appreciated, and look forward to talking to you again in 2024.
Yes, my pleasure indeed.
That's Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian Fund Management Industry Consultant Stuart Aldcroft, Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, and our US economics correspondent, writer and broadcaster, Barry Wood. See you tomorrow.
Money Talk.